Every trade you make, you're fighting two battles, one with the market and one with yourself. Greed pushes you to act quickly, but patience teaches you to wait. So how do you know when to give in to one and when to hold back? The market doesn't care about your emotions, yet your emotions are what will decide whether you win or lose. It's a battle that every trader faces, and it's silent. Because it's not the charts or the technical analysis that will make or break you. It's the war going on inside your mind. You've probably felt it yourself. The rush when a trade goes in your favor, or the panic when it doesn't. One moment you feel invincible, like you've unlocked the secret to trading. The next, doubt creeps in, and suddenly you're questioning every move. But what if I told you that the key to success in trading isn't about finding the best strategy or making the quickest gains? The truth is, the real battle happens within you. Importance of discipline in trading. Trading isn't just about understanding charts, indicators, or finding the perfect entry points. It's about controlling your own mind. The market will give you every reason to act impulsively, to chase after quick profits, to take risky trades when you feel like you're missing out, or to abandon your strategy in the heat of the moment. Greed tells you to act quickly, jump on every opportunity, and take big risks for big rewards. Patience, on the other hand, asks you to sit back, evaluate, and wait for the right moment. But how often do we listen to patience? How often do we allow greed to guide our decisions instead? It's easy to get caught up in the excitement of the moment. It's easy to think that the next trade could be the one that changes everything. But what separates the successful traders from the unsuccessful ones isn't their knowledge of the market. It's their ability to manage their own emotions. The real challenge is not just reading the charts or understanding technical analysis. It's being able to read yourself. The market will give you signals, but your mindset will determine whether you act on them wisely or impulsively. This internal battle is what determines whether you thrive or falter in trading. In this video, we're going to dive into the silent war between greed and patience that plays out in every trader's mind. We'll uncover how these two forces impact your decision-making and why understanding them is crucial to achieving consistent success in trading. Greed can lead you to overtrade, chase losses, and make reckless decisions. Patience, on the other hand, can help you stay grounded, focused on your strategy, and avoid making impulsive moves that can harm your account. Through real-life examples, practical strategies, and actionable advice, we will explore how to recognize when greed is influencing your decisions, how to cultivate patience in the heat of the moment, and how to find the balance between the two. We'll also discuss how patience isn't about waiting passively, but about making intelligent, strategic decisions, while greed is about short-term thrills that can ultimately burn you out. Whether you've been trading for months or years, this video will give you the tools to master your emotions and improve your trading mindset. By the end, you'll have actionable insights into how to handle the psychological pressures of trading, allowing you to navigate both the market and your own impulses with greater ease and success. Are you ready to take control of the silent war? Let's dive in. Understanding greed and patience in trading. Greed in trading is the desire for quick profits and the impulse to act on every opportunity, no matter how risky it may seem. It often drives traders to chase after trades that aren't part of their strategy, push positions too far, or increase risk in an attempt to make up for previous losses. Greed tells you to go big or go home, to make large bets with the hope of huge rewards. The problem with greed is that it distorts reality. A trader driven by greed often ignores risk management, convinced that the next trade will bring in massive profits. But more often than not, this mindset leads to overconfidence, and overconfidence leads to mistakes. For example, a trader might see a small opportunity and, in a moment of greed, think, if I just increase my position size, I can make more profit. But this often backfires when the market moves against them. Greed also comes from a deep desire to make up for losses. After a losing trade, it's easy to feel frustrated and think you need to recover that loss quickly. This desperation can cause traders to make impulsive decisions, like taking unnecessary risks or breaking their own rules, in an attempt to get back the money they've lost. Unfortunately, this cycle often leads to even greater losses. Patience, on the other hand, is the ability to wait for the right opportunities, to stick to your trading plan, and to let your strategy play out over time. Patience isn't about waiting idly, hoping for something to happen. It's about being strategic and waiting for the market to align with your plan. It means staying calm, even when the market moves against you, and trusting the process. Patience in trading is rooted in long-term thinking. A patient trader doesn't expect quick results. Instead, they understand that success in trading comes from steady, consistent actions over time. For example, a patient trader is content with small gains, knowing that over time, compounded growth will lead to significant results. They avoid the temptation of quick profits and focus on making decisions that align with their plan and risk tolerance. Moreover, patience allows traders to wait for the right setups. In the heat of the moment, it's easy to be swayed by the market's volatility. Patience, however, gives you the ability to pause, evaluate, and wait for the market to provide a higher probability setup. Rather than jumping into every trade, a patient trader waits for conditions to meet their criteria before entering a position. The psychological impact of greed versus patience. Greed and patience affect a trader's mindset in different ways. Greed often triggers strong emotional responses, like excitement, fear of missing out, FOMO, and the thrill of making a big win. These emotions cloud judgment and lead to decisions that might not be aligned with a sound strategy. For example, greed can drive a trader to chase a trade after seeing a price move quickly, even if it goes against their planned strategy. This leads to rash decisions and emotional decision-making, which is never a solid foundation for long-term success. Patience, in contrast, fosters emotional stability. It allows traders to make clear, logical decisions rather than reacting emotionally. When a trader practices patience, they approach each decision with a calm mind, free from the pressure of urgency. Patience means waiting for a good opportunity rather than forcing one. It also means being comfortable with the fact that not every trade will be a winner, and not every moment in the market will be perfect. The key psychological advantage of patience is that it helps traders maintain a sense of control. The market is unpredictable, and it can create emotional turbulence. Patience gives traders the strength to ride out those emotional waves without making impulsive decisions that deviate from their strategy. Greed, on the other hand, is driven by a fear of missing out on potential gains. It creates a sense of urgency that can cloud judgment, causing traders to make hasty, reactive decisions. How greed and patience affect your trading results. The way greed and patience affect your results is fundamental to understanding trading success. Greed, when left unchecked, can lead to overtrading and excessive risk-taking, which ultimately erodes your capital. Every decision driven by greed, whether it's increasing position sizes, breaking risk management rules, or chasing trades, sets you up for failure in the long run. You might win occasionally, but those wins often don't compensate for the losses that come from trading impulsively. Let's consider an example. Imagine you're trading with a $1,000 account. After a few losses, you feel frustrated. Greed takes over, and you decide to risk a large portion of your account on a trade, hoping to make it all back. But the market doesn't go in your favor, and you lose even more. Now, instead of taking a step back and reevaluating, you go all in once more, convinced that the next trade will turn things around. This vicious cycle continues until your account is wiped out. This is the power of unchecked greed. Patience, on the other hand, leads to more consistent and sustainable growth. A patient trader doesn't look for the quick win, but focuses on preserving capital and making calculated decisions. They understand that not every trade needs to be a winner, and losses are simply part of the process. Instead of forcing trades when the market is unpredictable, patient traders wait for the right setups and trade with confidence. Let's flip the scenario above. A patient trader facing the same losses takes a break, reviews their strategy, and sticks to their plan. They might make smaller, more calculated trades that fit their criteria. Over time, the losses are recovered, and the account begins to grow again. This gradual, disciplined approach allows patience to compound profits while protecting the trader from the emotional damage caused by reckless decisions. Balancing greed and patience. Now that we've examined the impact of both greed and patience on trading, it's important to understand how to strike a balance between the two. Trading isn't about eliminating greed entirely or practicing patience all the time. It's about knowing when to lean into each force. Greed can be an ally when it pushes you to take calculated risks that align with your strategy. There are moments when a bold move can pay off, especially if you've done your homework and the setup is right. However, greed becomes dangerous when it causes you to act impulsively, risk too much, or chase after a trade that doesn't fit your strategy. Patience, on the other hand, should be your anchor. It helps you stay grounded during tough times and prevents you from chasing every opportunity. But remember, patience doesn't mean being passive. It means waiting for the right setup and allowing your strategy to unfold over time. The goal is to find a balance where you can embrace the right amount of risk when the opportunity presents itself, but avoid overextending yourself or getting caught up in the excitement of the market. By recognizing the signs of greed and practicing patience, you can develop a mindset that promotes long-term success rather than short-term wins. With patience, you'll make smarter decisions, avoid the trap of overtrading, and stay focused on your long-term goals. The price of greed, common pitfalls and mistakes. One of the most damaging effects of greed is overtrading. Greedy traders often feel the need to be in the market constantly, chasing every potential opportunity, regardless of whether it aligns with their strategy. The fear of missing out, combined with the urge to get back what they've lost, becomes irresistible. Revenge trading is another common mistake. After a loss, it's easy to feel frustrated or wronged by the market. In an attempt to recover that loss quickly, traders dive back in without taking the time to analyze the next trade properly. They make larger, riskier bets to make up for the previous loss, believing it's a sure way to recover. Unfortunately, this only leads to deeper losses and creates a dangerous cycle of emotional trading. The issue with both overtrading and revenge trading is that they're driven by emotion, not reason. When emotions dictate your actions, you ignore risk management and the rules you've set for yourself. Over time, this can deplete your trading capital and confidence, leading to a much bigger loss than you initially intended. Chasing losses. Chasing losses is a dangerous mindset that comes from greed's fear-driven nature. After a losing trade, traders often think that they're due for a win. This leads them to increase their risk in an attempt to make back the money they lost. They believe that one successful trade can reverse the previous losses, so they take bigger positions than usual. Here's an example. Imagine you lose a trade, and instead of following your strategy and cutting losses, you decide to increase your position size on the next trade. You tell yourself, this trade will turn things around. But if the market moves against you again, now you're in a much worse position. What was once a small loss becomes a much bigger problem. Chasing losses often leads to overestimating your ability to handle risk. You may think that you can afford larger positions, but the emotional pressure to recover a loss can cloud your judgment. It creates a vicious cycle of greed-driven decision-making, where the fear of loss overpowers rational thinking, resulting in more mistakes. Ignoring your trading plan. A well-structured trading plan is the foundation of disciplined trading. It guides your decision-making and keeps you focused on your long-term goals. However, when greed takes hold, traders tend to abandon their plans, thinking that one trade can change everything. They jump into a trade because it feels right, or because they see a potential quick profit, disregarding their strategy and risk management rules. This is where things start to unravel. When you ignore your trading plan, you are no longer following a proven strategy, you're simply acting on impulse. Greed often convinces you that a single opportunity is too good to pass up, even if it doesn't align with your plan. Let's say your plan allows you to risk only 2% of your account per trade. However, driven by greed, you increase your position size on a trade because you think the reward outweighs the risk. But the trade goes against you, and now you're facing a loss that's larger than you can handle. You've broken your rule, and the consequences are steep. Ignoring your plan may provide a quick thrill, but it disrupts the consistency and discipline that are key to long-term success in trading. The consequences of greed. Greed doesn't just lead to financial losses, it has far-reaching emotional and psychological consequences. In the short term, the most obvious consequence is a loss of capital. However, the deeper impact comes from the erosion of your confidence. Each time you break your own rules, overtrade, or chase losses, you reinforce bad habits. These habits, when left unchecked, can be difficult to change, making it harder to return to a disciplined approach. The emotional toll is significant as well. Greedy traders often experience a roller coaster of emotions: exhilaration after a win, devastation after a loss, and frustration when things aren't going their way. This emotional volatility clouds judgment and leads to poor decision-making. Eventually, many traders burn out or give up altogether, feeling like they can't regain control. Traders who constantly act on greed often find themselves in a continuous cycle of chasing profits. They may win sometimes, but the losses are what stick with them, especially when they've gambled more than they can afford to lose. The key to overcoming greed is breaking free from this cycle and learning how to trade with discipline. How to break the cycle of greed. Breaking the cycle of greed starts with awareness. Recognizing when greed is influencing your decisions is the first step toward regaining control. Once you understand the psychological triggers that drive greed, you can take action to counteract them. The second step is to stick to your trading plan. Have clear rules in place for risk management, position sizing, and trade criteria. Every time you feel the urge to jump into a trade that doesn't fit your plan, pause. Ask yourself if this decision is backed by logic and strategy or driven by emotion. If it's driven by emotion, walk away. Taking a break to clear your head can help you refocus on your long-term goals rather than short-term gains. Mindfulness also plays a key role in curbing greed. Before each trade, take a deep breath and check your mindset. Are you making this decision because of excitement or fear, or is it based on your strategy and analysis? Mindfulness helps slow down the decision-making process and allows you to assess the situation calmly, ensuring that your decisions are in line with your plan. Greed is a powerful force, but it's one that can easily lead to destructive behavior in trading. Overtrading, chasing losses, and ignoring your trading plan are all symptoms of a greed-driven approach. These mistakes are costly and over time can erode your capital and confidence. The key to overcoming greed is discipline. By sticking to your plan, being aware of emotional triggers, and practicing mindfulness, you can break free from the cycle of impulsive trading and start making decisions that align with your long-term goals. Trading isn't about chasing quick wins. It's about consistent, steady growth. The more disciplined you are, the more likely you are to succeed in the market. Why patience is the true strength. Patience is often underestimated in trading. Traders tend to focus on fast gains, thinking that quick, impulsive decisions are the key to success. However, the truth is that patience is the true strength that drives consistent, long-term profitability. The ability to wait for the right setup, to avoid jumping into trades prematurely, is what separates successful traders from the rest. When you're patient, you don't rush decisions. You wait for high-probability setups, those moments when the market aligns perfectly with your strategy and risk management rules. This is the foundation of disciplined trading. Waiting for the trade that fits your criteria, rather than forcing trades in the hope of a quick win. It's about acting with precision, not emotion. Patience isn't passive. It's an active choice to wait for the most favorable conditions. It's the discipline to step back when the market isn't offering clear opportunities and not giving in to the temptation to trade just because the market is moving. As the saying goes, patience is a virtue, and in trading, it's a key ingredient for long-term success. The role of a trading plan. Having a solid trading plan is deeply tied to practicing patience. A well-defined plan is your roadmap. It sets clear rules for when and how you'll trade. But more importantly, a trading plan helps you resist the urge to act impulsively when emotions like greed or fear are running high. Without a trading plan, you're more likely to rush into trades, hoping that the market will move in your favor. This impulsiveness is often driven by impatience, and it's one of the quickest ways to sabotage your trading career. A solid plan forces you to stick to the strategy, no matter how enticing a trade may seem. When you follow a plan, you don't feel pressured to trade when conditions aren't ideal. You know that your next opportunity will come, and you trust the process. By adhering to your plan, you allow patience to be your guide. You take trades only when your plan signals an opportunity, and you avoid the temptation to deviate. This leads to more consistent, well-thought-out decisions. And over time, that consistency pays off. Risk management and patience. One of the most significant ways patience manifests in trading is in the practice of risk management. It takes a lot of discipline and patience to respect your stop-loss levels, especially when a trade is moving against you. Many traders, especially beginners, struggle with this. They might want to hold on to a losing trade in the hope that the market will reverse, but that's a failure to practice patience and risk management. When you follow a disciplined risk management strategy, you're essentially saying to yourself, I trust my plan, and I'm willing to accept that losses are part of the process. Patience plays a crucial role here. Instead of letting your emotions take control and making reckless decisions, you stick to your rules and accept the outcome of each trade. For example, if you set a stop loss and the market reaches it, patience allows you to exit the trade without hesitation. You don't try to outsmart the market by moving the stop loss or holding onto a trade longer than you should. This is a fundamental part of managing your risk effectively, and it requires immense patience. Delayed gratification in trading. Delayed gratification is the art of waiting for the right moment rather than seeking instant rewards. Impulsive traders often chase the thrill of immediate profits, but seasoned traders understand that sustainable success comes from small, consistent wins over time. Delayed gratification teaches you to resist the urge for quick wins and focus on building a strong trading foundation. Imagine you make a trade based on solid analysis, but instead of jumping into the market when the setup is perfect, you wait for the price to reach a more favorable entry point. This decision might result in smaller profits initially, but over time, those consistent, smaller wins compound. It's about focusing on the long-term game rather than the immediate rush. A trader who waits for the right setup is more likely to come out ahead in the long run. They may experience fewer wins compared to those who trade impulsively, but their profits are more sustainable. The key is understanding that building wealth in trading is a marathon, not a sprint. Patience in this regard allows you to grow your account steadily, focusing on consistent progress rather than looking for the next big win. Example: the power of waiting. Let's consider a practical example to demonstrate the power of patience. Imagine two traders, Trader A and Trader B. Both have similar skills, knowledge, and strategies. The only difference is that Trader A is patient, while Trader B is impulsive. Trader A waits for the right setups, executing only when all criteria align with their plan. On the other hand, Trader B jumps into trades at the slightest hint of movement in the market, hoping for fast profits. Over the course of a year, Trader A takes fewer trades but wins consistently, while Trader B takes many trades, often yielding inconsistent results. Trader A's account grows steadily, while Trader B's account experiences many highs and lows. Eventually, Trader A ends up with more profits, despite having taken fewer trades, because their strategy focused on quality, not quantity. This scenario highlights the importance of patience in trading. Trader A's ability to wait for the right moment while avoiding impulsive decisions sets them up for long-term success. In contrast, Trader B's impatience leads to more losses, even though they're taking more trades. This example clearly illustrates that patience is the key to turning small wins into long-term profits. Conclusion: patience, the secret to consistency. In the fast-paced world of trading, it's easy to get caught up in the thrill of quick wins or the fear of missing out on opportunities. But patience is the foundation that will help you achieve lasting success. By sticking to a solid trading plan, respecting risk management rules, and practicing delayed gratification, you're setting yourself up for sustainable growth. Patience allows you to avoid impulsive decisions, keep your emotions in check, and trust your strategy. Over time, this consistent approach will yield greater rewards than the rush of short-term gains. A trader who understands and practices patience is more likely to navigate the ups and downs of the market and emerge as a consistent, profitable trader. Balancing greed and patience, striking the right chord. In trading, the battle between greed and patience is a constant one. The most successful traders are not those who lean entirely into one of these forces, but rather those who know how to strike the right balance between the two. The ideal trader understands when to embrace greed's urgency for action and when to step back and let patience take the lead. Greed is often associated with the rush to make quick profits, while patience is linked to waiting for the perfect setup. However, both qualities can be powerful allies when balanced correctly. Too much greed, however, leads to hasty decisions and overtrading, while too much patience may result in missed opportunities and stagnant growth. Recognizing the signs of greed. Greed often sneaks into your decision-making process, especially during moments of high anxiety or excitement. It manifests when you feel the need to act quickly because you fear missing out on a potential opportunity. Greed thrives in these moments of uncertainty, pushing traders to take impulsive actions that are often not well thought out. One clear sign that greed is taking over is the desire to get rich too quickly. If you find yourself looking at every market movement with a sense of urgency, as though every minute missed is a missed fortune, then greed is clouding your judgment. Another warning sign is the constant need to be in a trade, especially when no high-quality setups exist. The fear of missing out or not doing enough often leads to poor decision-making. Greed also manifests when traders take on positions that exceed their risk tolerance or ignore their own rules. For example, you may feel the temptation to double down on a losing trade in the hopes of a recovery, or take a much larger position than your strategy calls for in the hopes of making bigger profits quickly. Example, a trader sees a market moving upward and becomes excited. Despite having no clear confirmation, they jump into the trade with a larger position than they normally would, thinking it will continue moving in their favor. The market reverses, and they lose a significant portion of their capital. This happens because greed convinced them to ignore their trading plan. Knowing when to be patient. Patience is often misunderstood. It's not about waiting aimlessly for an opportunity to come to you. It's about understanding when to stay out of the market and avoid unnecessary risks. Patience is about waiting for the right moment when the market aligns perfectly with your plan. The key here is recognizing that not every market movement needs to be acted upon. One of the hardest aspects of patience is knowing when to do nothing. The market will always offer opportunities, but those opportunities are not always worth taking. A patient trader understands that sometimes the best decision is to wait and not trade at all. When market conditions are volatile or unclear, the urge to act can be strong. However, a patient trader knows that they're not missing out. They're simply waiting for a better, more predictable opportunity. Patience is about trusting the process and respecting your own strategy. You know that opportunities will present themselves if you're consistent with your approach. Waiting for high-probability setups rather than chasing random trades is where patience pays off in the long run. Strategies for balancing both forces. Balancing greed and patience doesn't mean avoiding one completely or being ruled entirely by the other. It requires a constant awareness of your emotional state and a commitment to your trading plan. Here are some strategies to help you strike the right balance. Setting specific goals, e.g., daily or weekly profit targets. One of the most effective ways to balance greed and patience is by setting clear and achievable goals. These goals act as a guide, keeping you grounded and focused on the long-term picture. By setting daily or weekly profit targets, you avoid the urge to chase every opportunity. This approach helps prevent greed from pushing you to take excessive risks. Example: a trader sets a goal of making 2% profit each week. Knowing that this goal aligns with their strategy, they are less likely to chase after high-risk trades that don't fit their criteria. This focus on consistent, manageable profits reduces the temptation to act impulsively. Practicing mindfulness or emotional check-ins during trading sessions. The battle between greed and patience is psychological. One way to manage this internal conflict is by incorporating mindfulness techniques or emotional check-ins during your trading sessions. Regularly checking in with your emotions allows you to recognize when you're becoming anxious, fearful, or overly excited, which are all signs of greed. Mindfulness can help you acknowledge these emotions before they lead you to make impulsive decisions. Simply taking a few moments to breathe, reflect, and ask yourself if your current action aligns with your plan can be a powerful tool for maintaining balance. Example: before making a trade, a trader asks themselves, "Am I trading because the market conditions fit my strategy, or because I'm feeling anxious and need to act?" This pause allows the trader to assess their emotional state and make a more informed, patient decision. Using cool-down periods after a loss or win emotions run high after both wins and losses, and these moments can heavily influence your next trade. After a win, you may feel invincible and tempted to increase your position size, while after a loss, you might feel the need to make up for your losses quickly. Both situations are fueled by impatience and the desire for immediate gratification. A cool-down period can help you reset emotionally. After a trade, whether a win or a loss, take a break. This gives you a chance to regain clarity and perspective before jumping into your next trade. Giving yourself this time helps you avoid acting impulsively and allows you to approach the next decision with a calm, balanced mindset. Example: after a loss, a trader takes a 15-minute break from the screen to reset. They avoid the temptation to immediately jump into another trade. This brief cool-down period helps them approach the next trade with a fresh perspective, avoiding the emotional pitfalls of revenge trading. Creating a plan for each trade. Having a detailed plan for each trade ensures that your decisions are based on logic, not emotions. A clear plan outlines your entry points, exit points, stop-loss levels, and position size. When you're prepared with a plan, it's easier to resist the urge to deviate from your strategy in moments of greed or fear. Every trade should have a set of rules that you follow without exception. These rules will help you act with discipline and patience, as they take the emotional aspect out of the equation. By sticking to your plan, you make decisions based on data and strategy, rather than emotions like impatience or greed. Example: before entering a trade, a trader writes down their plan, the entry point, stop-loss level, and target. Having this clear plan gives them confidence to follow through without making impulsive changes based on market movements. Practical tips to develop patience in trading. A trading plan is not just a set of rules, it's the foundation that ensures your patience is rooted in structure. Without a plan, a trader's decisions are at the mercy of their emotions: fear, greed, impatience, leading to rash, impulsive choices. A well-defined trading plan not only gives you direction, but also reinforces the concept of patience by laying out specific criteria for when and how to take action. At the core of any good plan is risk management, setting stop-loss orders, determining position sizes, and ensuring that you never risk more than a small percentage of your capital on any single trade. This requires a great deal of patience because it encourages traders to wait for setups that align with their strategy and avoid taking trades simply because they feel right in the moment. Another critical aspect of a trading plan is defining your entry and exit strategies in advance. Knowing exactly what you're looking for reduces the temptation to chase market movements or enter trades prematurely. The more thorough and disciplined your plan, the more confident you will be in sticking to it, regardless of the market's short-term fluctuations. Example: consider a trader who has carefully planned a strategy around a particular technical indicator. Their plan dictates entering a trade when the indicator shows a clear buy signal and exiting with a preset profit target or stop-loss. They wait patiently for the setup to emerge instead of jumping into trades based on emotion or market noise. The structure of their plan allows them to ignore distractions and stick to their strategy. Mindset shifts. One of the most powerful tools a trader can develop is the ability to shift their mindset. Trading is not about getting rich quickly or beating the market. It's about consistency and following your strategy over time. To develop patience, a trader must shift their focus from the immediate outcomes of each trade to the long-term process of growing their account. Traders often get fixated on wins and losses, letting them define their emotional state. A win can trigger overconfidence, leading to risky trades, while a loss can result in feelings of frustration or desperation. The key to developing patience is detaching from the outcome of each individual trade. Instead of viewing every trade as a make or break moment, successful traders focus on following their process, knowing that, over time, sticking to their plan will lead to success. Example: a trader who has a strategy with a 60% win rate doesn't obsess over a single loss. Instead, they focus on the process and trust that over time, their edge will pay off. If they lose a trade, they simply review their plan and move on, knowing that the next opportunity will come and they'll be prepared for it. Another critical mindset shift is understanding that perfection is not the goal in trading. No one can win every trade, and trying to do so will only lead to frustration. Instead, embrace the idea of incremental improvement, learning from every trade, whether it's a win or a loss, and building on your knowledge and experience. Setting realistic expectations. Setting realistic expectations is one of the most important steps in developing patience. Many traders enter the market expecting quick profits, often ignoring the gradual nature of real trading success. The reality is that trading is a marathon, not a sprint. Most successful traders understand that growth in trading is slow and steady, and they make consistent progress over time. Setting small, achievable goals allows traders to stay motivated and focused. These goals should be specific, measurable, and time-bound. Instead of aiming for large, unrealistic profits in the short term, set weekly or monthly goals for profit growth. Focus on improving your consistency, sticking to your trading plan, and managing risk effectively, rather than chasing after huge returns with every trade. Patience is nurtured when traders stop focusing on the quick wins and instead concentrate on developing long-term, sustainable success. Understanding that the journey is just as important as the destination can make it easier to stay patient during times of stagnation or when things aren't going your way. Example: a trader might set a goal of increasing their account by 5% per month. While it may seem like a modest amount, it compounds over time. If they focus on hitting this target each month, rather than trying to double their account overnight, they're more likely to see steady, long-term growth, which helps cultivate the patience needed for trading success. Tools and techniques. Developing patience in trading requires more than just mental shifts. It also involves practical tools and techniques that help reinforce good habits and discipline. Here are a few methods to help you stay patient and focused. Journaling trades and emotions. One of the most effective ways to build patience in trading is through journaling. A trading journal helps you track your trades, the rationale behind each decision, and the emotions you felt during the process. By regularly reviewing your journal, you can identify patterns in your trading behavior, such as acting impulsively out of greed or impatience, and work on correcting them. Journaling also allows you to reflect on your wins and losses, helping you detach emotionally from the outcomes. Instead of focusing on how much you made or lost, you can analyze whether you followed your plan and made logical decisions. Example: a trader writes in their journal after each trade, noting the reasons they entered and exited the trade. They also record how they felt, whether they were anxious, confident, or unsure. Over time, they see patterns in their emotional responses and realize when they tend to rush decisions, helping them adjust their mindset for future trades. Reviewing performance over time. Instead of obsessing over daily results, take time to review your performance over weeks or months. Successful traders understand that trading is about long-term consistency, not short-term wins. Regular performance reviews help you see the bigger picture and keep you focused on steady progress. By focusing on your performance over time, you'll also see that even periods of drawdown or losses are just part of the process. The more you look at the long-term growth of your account, the easier it becomes to remain patient, knowing that the best results often come after periods of consolidation or slower progress. Example: a trader reviews their results at the end of each month, noting their cumulative gains and losses. This longer-term view helps them see the progress they've made, even if individual trades didn't yield immediate success. Practicing discipline through other aspects of life. Patience isn't just about trading, it's a mindset that can be cultivated through other areas of your life. Practicing discipline in your personal habits, such as maintaining a regular exercise routine or following a healthy diet, can help strengthen your overall patience. By incorporating discipline into other areas of life, you can make it easier to apply the same principles to your trading. Developing a routine that prioritizes consistency, self-control, and delayed gratification will help you handle the emotional ups and downs that come with trading. Example: a trader who practices mindfulness and self-discipline in their fitness routine finds it easier to apply these skills to their trading. They use the same patience and consistency they've developed from exercise to wait for optimal trading setups rather than rushing into a trade out of impatience. Handling market volatility, staying patient. Under pressure. Market volatility is an unavoidable part of trading, but for many traders, it's also a major emotional trigger. As prices fluctuate wildly, traders often feel an intense urge to act quickly, either to seize an opportunity or to recover from a recent loss. This is where greed and impatience can take hold, pushing traders to make decisions that are not based on their trading plans, but rather on emotional impulses. The fear of missing out, FOMO, can be amplified during volatile times. Watching the market make sharp movements, either up or down, can make you feel like you need to act immediately, like if you don't, you might miss the chance to profit. The reality, however, is that these sudden price swings often cause more harm than good. Greed convinces traders that they must capitalize on every move, while impatience leads them to enter trades without waiting for proper setups. The most common mistake during volatility is overtrading. Traders who give in to the urge to trade every swing often find themselves on the losing side of the market. They enter positions too quickly, hoping for a quick win, and are caught off guard by the unpredictable nature of volatile conditions. When volatility spikes, the market can move in any direction, and the risk of being caught on the wrong side of a trade is significantly higher. Example: imagine a trader who sees a sudden market dip and fears missing out on a rebound. They immediately jump in without confirmation from their strategy, hoping to ride the wave back up. The market continues to drop, and they find themselves in a losing position, all because they allowed the volatility to cloud their judgment. Strategies to maintain patience in volatile markets. Sticking to your trading plan. The first rule of staying patient during volatility is to stick to your trading plan. When volatility hits, emotions can cloud your decision-making, but having a solid plan in place keeps you grounded. Your trading plan should include clear guidelines for when to enter, exit, and how much risk to take on each trade. By following your plan, you remove the emotional aspect of trading and avoid reacting impulsively to market movements. One way to stay disciplined is to define specific criteria for trade entries and exits. When the market is volatile, it's easy to get distracted by short-term price swings. But if you've set clear rules about what qualifies as a valid setup, you can avoid jumping into trades just because the market is moving. Example: a trader following a plan might decide that they will only enter trades after a specific technical indicator aligns with their strategy, even if the market is moving rapidly. By sticking to this rule, they avoid chasing the market and stay patient for the setups that meet their criteria. Limiting trade frequency during high volatility. In volatile markets, it's crucial to limit the frequency of your trades. High volatility doesn't always mean more opportunities. It often means more risk. A common mistake is overtrading during volatile periods, thinking that more trades equal more chances to profit. In reality, overtrading can lead to more losses, as the market's unpredictable movements increase the likelihood of being caught in a bad position. Limiting your trades during high volatility forces you to be more selective about when to enter the market. Rather than reacting to every swing, you wait for a clear setup that aligns with your plan. It's about quality, not quantity. This focus on fewer, more calculated trades reduces the emotional toll of constant decision-making and helps you remain patient. Example: a trader who usually takes several trades a day might reduce their activity to just one or two during a period of high volatility. They focus on waiting for high-probability setups rather than jumping into every trade that shows movement. Avoiding excessive risk volatility can distort your perception of risk. When the market moves quickly, there's often a temptation to take on more risk in order to capitalize on potential rewards. However, increasing your risk exposure during volatile periods is a recipe for disaster. The key to staying patient and disciplined is to stick to your predefined risk management strategy. This means continuing to set stop-loss levels and adhering to them even when the market is swinging wildly. It's easy to think that you'll get lucky and that this time the market will reverse in your favor. But that kind of thinking is dangerous. Instead, you must trust your system and risk management rules, even when volatility tempts you to deviate. Example: during a volatile market event, a trader who usually risks 1% per trade might be tempted to double their position size in an attempt to profit faster. However, if they stick to their 1% risk rule, they preserve their capital and avoid blowing up their account. Dealing with drawdowns and losses. Drawdowns and losses are part of the trading game, but they become especially challenging during volatile periods. The psychological stress that comes with seeing your account balance drop can trigger emotions like frustration and self-doubt, making it even harder to stay patient. But it's during these moments that your ability to remain calm and patient will define your long-term success. The key to handling drawdowns is understanding that losses are inevitable. No trader, no matter how skilled, wins 100% of the time. Instead of seeing losses as personal failures, successful traders view them as part of the process. During drawdowns, it's important to stay patient and trust in your strategy. Don't make impulsive decisions or chase after quick wins to make up for the loss. Stick to your trading plan and trust that, in the long run, consistency will lead to success. Example: A trader experiences a series of losses during a volatile market period. Instead of panicking or abandoning their strategy, they review their trades to see if they followed their plan correctly. They acknowledge the losses as part of the journey and remind themselves that success in trading comes from sticking to their process, not from winning every trade. Developing emotional resilience. Dealing with volatility also means developing emotional resilience. The ability to stay calm under pressure is crucial in volatile markets, and this skill comes with practice. When market conditions are turbulent, resist the urge to react emotionally. Take breaks when needed, and always ensure that you're mentally prepared before you enter a trade. One way to build emotional resilience is through mindfulness or stress management techniques. Take deep breaths, focus on the present moment, and remind yourself that you're not trading to win every time, but rather to follow your plan and manage risk effectively. Example: after a series of losses during a volatile market period, a trader takes a walk outside, clears their mind, and returns to their desk with a refreshed perspective. This brief cool-down helps them avoid rash decisions and approach the market with a level head. Throughout your trading journey, you'll constantly face the tension between greed and patience. Greed pushes you to act quickly, driven by the desire for immediate profits, while patience teaches you to wait for the right moment, to be strategic and disciplined. Mastering the art of patience isn't about eliminating greed altogether. It's about learning how to manage it. Recognizing when greed is influencing your decisions and knowing when to step back and trust your process is the key to long-term success. As you grow as a trader, this battle will become more refined. With each trade, you'll learn to harness your emotions, and with practice, you'll find that your decisions are driven more by logic and strategy than by fleeting desires. Patience isn't just a trait, it's the foundation of lasting discipline. As you develop patience, you also build the mental resilience needed to stick to your trading plan, avoid impulsive decisions, and ride out the rough patches. The rewards of this disciplined mindset are profound. It transforms your approach to trading, helping you achieve steady growth, increase consistency, and navigate the inevitable ups and downs of the market with greater ease. Embrace the challenges ahead, knowing that every setback is an opportunity to grow. Patience, like any skill, takes time to develop, but the rewards are well worth the effort. Keep pushing forward, stay disciplined, and remember that the journey is just as important as the destination. As you continue to master the art of patience, you'll unlock the full potential of your trading career and step closer to becoming the trader you aspire to be.